Happy Wednesday, happy rainy Wednesday, everybody. So we're doing our weekly call with David Gazarian. We're looking forward for him to join us. There he is. And today, as always, we're going to be talking about mortgages, the current mortgage questions. We're going to talk about the interest rates and what is going on in the mortgage and real estate market. David, can you hear us?
Morning, Alexandra. I can. Good morning. Morning, everyone.
Morning. So, can't wait to hear the good news, the bad news, and not so bad news.
Okay.
In the mortgage industry.
Yes. Well, I guess the only good news that caught my eye was the FHA mortgage insurance being reduced, and that's live today. That's we can originate today, and that changes the whole game. In the past, we would for someone with a high credit score, we would definitely sort of consider conventional, and you always do the work. You compare both if they qualify for both. And conventional, even though it has a higher interest rate, it would end up being lower in payments. And now, since FHA by default has low interest rates, and the fact that PMI went down, now FHA is going to beat conventional 9 out of 10 times.
So one more time, we have the mortgage insurance on the FHA loans as of March 1st being lower, correct? That will help FHA borrowers to get a lower payment, as well as to bring less money to the close of escrow. Is that correct?
That's right. Yes, that is.
And on average, like, is there an average number that is going to be like that we are going to apply? Is it going to be like 0.5% lower? What is the, like, how much did they decrease it? Like, can we calculate it, or?
Yeah. So when you with FHA being the lower down payment, the lowest down payment with FHA would be 3.5%. If you put 3.5%, then your mortgage insurance premium per year, the annual premium, would be 0.85% of your loan amount, right? So that is being reduced by 30 basis points. It's going to be 0.55 now. And the reason it's so exciting is conventional mortgage insurance for folks that have like 740 or higher credit score would be lower, much lower than FHA in the past, and because of that we would end up choosing conventional. Now we don't have to, because FHA has lower mortgage insurance.
Excellent. And David, if you could remind us the amounts of the conventional FHA mortgages
loan
at some
amounts.
point. Yes, the loan amounts, the maximum loan amounts.
So let's stick with Clark County. FHA loan limit, in Clark County is 472 this year. It gets adjusted to inflation. It was a huge jump, but so as of this moment, all the way to like the end of this year, it's going to be 472. And obviously, the Federal Housing Administration will announce a higher number, closer to 500, I'm assuming, by the end of the year, hopefully even above 500. That's for FHA.
And David, when we're talking about the loan limits, so if we're talking about 472 is the maximum loan amount, but it doesn't mean that, like, let's talk about the difference between the purchase price and the loan amount, because this is something that, I've been working with our buyers for a long time, and I know it is confusing, and I know that not even every agent who's been in the business for a while understands that, and let alone our poor, our customers, they don't understand it either, and it's hard to expect them to grasp it, like when they buy a house like once in 3-4 years. So can you please explain the difference between the purchase price and the loan amount, and how it affects, how one affects the other?
So, of course, and I know why this question originated, or because you and I are dealing with a client right now that that we had to explain.
We're explaining, we're breaking it down, but
of course.
like we have. This is not the only client who has this question. That's why I would rather have it in in writing on recording.
So yes, what's going to happen is, well, for example, for this, we're not going to name names, obviously. So that she was approved for $450,000 purchase price with, I believe, 5% down, which would be $22,500. This would be her purchase price at $450,000. If we're doing a 5% down loan, which is we're financing the 95% of the home, then if we say your purchase price is $450,000, that is the 100% of the purchase price that you can make an offer. You cannot make an offer for $455,000, $460,000. You're not qualified. Your income does not allow. Now, this means that your 5% down is going to get subtracted from your $450,000, and your loan amount's going to be, what is it, $437,500. That's going to be your 95% loan amount. So purchase price is 100%, and minus your down payment, which obviously we talk to the client and we decide what they can afford and what the best option is for them. And in this particular case, it's 5%. So the 95% loan amount is $437,000. Lots of people make the mistake of thinking that when we say $450,000 is your purchase price, for some reason they hear loan amount and they add another 5% on top of that, which is not accurate. Purchase price is the 100%. It's the bigger number. Then we subtract your down payment.
So for the ease of understanding, let's say our purchase price is $100,000. So guys, what we very much want you to understand, we have the purchase price. This is how much you're going to pay in total for the house, for the property. And then your loan amount, unless you're VA loan is going to finance 100% of the purchase price. So if we're working with the VA buyer, so we have a purchase price of $100,000 and the loan is going to be $100,000. So they're going to be equal. Now, if we're working with the FHA buyer, the minimum down payment that the buyer is going to bring in is 3.5%. This way, if we have a property with purchase price is going to be $100,000, then the loan amount is going to be $96,500, and then $3,500 the buyer has to bring as the down payment. Now, can the buyer increase the down payment? Yes, they can if they want to. Let's say the buyer wants to buy the house that is going to be that the value is going to exceed the maximum loan amount for FHA. I cannot do the numbers in my head right now, but let's say, like your maximum loan amount is going to be more than, like your loan amount is going to be $472. Can you buy the house that is worth more than that? Yes, you can, but then you need to understand that everything that exceeds that amount, like you either have to put more down payment or you're going to, you're going to compensate that money. If you're staying within the limits of the FHA loan, you're going to compensate it out of your pocket. And that's why we're very careful when we're operating with the loans. We're very careful. We always go back to the lender and we calculate all the numbers to make sure that the buyers are aware and the buyers are very educated on the two major amounts, the amount what their regular payment is going to be, what their monthly payment is going to be, and on the amount that they will have to bring to the close of escrow. Because one of the very common mistakes that we see and one of the biggest frustrations that the buyers come across when they don't get educated on this upfront is that there is down payment and there are closing costs. And And a lot of times, like those closing costs, they will run into thousands and thousands of dollars depending on the loan. And so if you have your down payment, like if you only have 3.5%, it doesn't mean that this is all the money that you need to bring. There are closing costs, there are loan origination fees that, yes, they could be rolled into the loan at some point. We can ask the seller to contribute. However, we need you to be aware that there is much more to the price of the loan besides your down payment. Am I correct, David?
Well, yes, I have a very extensive checklist that I go with clients when I go through it, so I don't forget anything. But we do stress everything, and we do give a special mortgage coach. It's a link, and it's got everything written down. We email that link to them so they can have access to it, open and look at every little detail from down payment to closing costs to closing cost breakdown of everything what closing cost is. Plus the components of their monthly payments, whether it's association, mortgage insurance, and all that stuff. So it can get intimidating, but once you ask questions, once you listen, it does clear up. It's not that complicated.
Well, it is a lot of numbers to wrap your mind around, and of course we understand that you guys don't do it every day. That's why we're here to help. So let's go back to our purchase price of $100,000. Let's say we're doing a conventional loan. So, David, what is the minimum down payment that we can do on the conventional loan?
Okay, so traditionally it's 5%. There are a couple of programs with 3% down, and loan officers don't talk about it very much. One is the Home Ready, which is a special first-time homebuyer program. It's the conventional's answer to FHA. So that's 3%, and there's also conventional 97, which again, not everyone falls within those categories. Traditionally, the simple answer is 5%.
If you guys, if you're eligible or if you qualify for the 3% down, obviously your loan officer is going to inform you, and you will have the chance to choose that option. But for the sake of, like 99.9%. People will be starting from 5% down. So if our purchase is $100,000, then your loan is going to be $95,000, and you're bringing $5,000 as your down payment. That does not include your closing costs or prorations that are actually associated with the loan. So, David, what is a jumbo loan?
Okay, so jumbo loan is, okay, let's talk about conventional. Conventional limit in Clark County is $726,000, right? So any loan below 726 is a conforming loan amount as far as conventional loans are concerned. Anything above the 726 is not conforming, hence it's a jumbo.
Okay. And when we're talking about jumbo, so 720 is the maximum amount for conventional. If you guys need the loan amount to be 725, you're already entering the
I think it's
jumbo.
726. Don't quote me on it.
Okay, let's say 800,000. Let's say if you're looking for a loan that is $800,000 or more, it's going to be a jumbo loan. Now, David, talk to us a little bit about jumbo loans. What is the specifics? What are the down payments? And are they easier? Are they harder to get? Or it's just the same loan, it's just the different package of paperwork?
Jumbo loans are going to be very, very different. Jumbo loans typically require slightly more origination, slightly more interest rate. They're just a different program. Now, there are banks that will do a 10% down jumbo loan, but traditionally you want to do 20 or 25% down. That would be my desire for the buyer. That would be my one of the things that I would ask the client if they could, because there's a big drastic drop in interest rate when you do, say, 25% down on a jumbo loan. I mean, you're probably looking at rates in 5s or low 6s versus rates in high 7s. So we're speaking March 1st of 2023. Obviously, this video will live on the internet forever. But so yes, jumbo loans will allow you to go up to, say, $2 million or depending on the lender, some lenders go up to $5 million of loan amount.
Excellent. So if we're seeking for the higher loan amount, David, where can, at any point of time, where should the consumer look up the loan limits, and how are they, like, are the loan limits based on the state, based on the county, like, where we're looking, like, where we're looking those up?
You could Google conforming loan limits in Clark County. They're definitely by county. And there are expensive, well, what's the term? High-priced counties such as Los Angeles County, which is I think the conforming loan limit's like $1 million, 980,000 or something. So it's much higher than Las Vegas. Obviously, and that's per single family home. If you've got a 2-dwelling or 3-dwelling or a 4-plex, obviously that limit goes up. High cost area would be Hawaii, District of Columbia, but it's definitely not Las Vegas.
I have the question. Are you looking up when you're financing? Let's say I live in New York and I want to buy something in Nevada.
Mm-hmm.
Am I looking up the loan limits in the county where I live in New York, or am I looking up at the loan limits at the county where I buy?
You're looking up the loan limits in the county where your real estate will be located that you'll be financing.
So the loan limits are going to be attached to the county where the property is located, no matter where you live. Correct.
It's not attached to you. It's attached to the property.
Excellent. Now, the next question is, when I'm living in New York and I want to purchase in Clark County, Nevada.
Right.
Am I allowed to use Nevada lender, or should I use the New York lender? How does that work?
If your New York lender is licensed in Nevada, you can. It's all about licensing, and Nevada is not an easy state to obtain a license with. So, I would say most loan officers out of state are not licensed in Nevada. So it's easier to contact someone inside Nevada, but obviously ask your lender if they're licensed in Nevada, and if they are, then they can help you.
Okay. And once again, should the lender be in the same state that where the property is located, or it is not a requirement?
It is not a requirement.
So if you wanted to, you can have your local lender. If you wanted to make this transaction easier and smoother and to get a little bit of more leverage on getting your offer accepted, you should be using the local lender where the property is located.
So that's a different subject. Of course, the seller's agent will prefer a David that's local. It's just a comfort level. When I call the listing agent, tell him, hey, I'm on Rainbow, I'm on Sunset, I'm off the 215. Hey, we've done enough work, and please accept our offer, versus a nationwide bank. My offer is going to hold all the weight, and it's going to beat out any 1-800 number lender's offer. But again, your question was if it's a requirement. It's not. If your lender's licensed in Nevada, they could physically be in New York, they could do the loan. But the local lender will be preferable when you make an offer. That's for sure. That's what experience has taught us.
Well, as the broker who represents both buyers and sellers, I can say that we do put a lot of weight on when we're receiving the offers for our sellers. We do put a lot of weight, and we check on the lenders. First of all, every single pre-approval letter, every single loan officer gets a call, and we talk to the loan officers before we present the offers. We do weigh the offers based on the down payment and based on the qualifications. And we do give the preference to the local lenders if we can. Like if we have two absolutely equal offers on the terms, the preference, like in 99.9% of the time, the preference will be with the local lender, just because it is easier to work with them. And, like, it is a material fact that we do present to the sellers based on the fact that we want to be in the same time zone. We want the lender to be aware of the areas and to be aware of the things that are customary for the state, for the county that we work in. And that is 100%. David, can you talk to me about pre-approval letter and pre-qualification letter?
Mm-hmm. Okay, so pre-qualification means different things to different people, even to different loan officers. Pre-qualify means I speak with a client and I pre-qualify them based on the conversation I have with them, based on their answers. Now, most people don't have the faintest idea what their income is because they always, especially if they're self-employed, they'll give you their gross number instead of net number. You know, I pull in $20,000 a month, and then you look at it, their income was less than $3,000 a month, showed paid for, reported to the IRS. So there's so many things that need to be verified. That's where pre-approval comes in. So I consider I have pre-approval, the word, on my pre-approval letters. I do, because these letters need to be presented to the buyer. They need to be presented to the listing agent. And the listing agent wants to vet us, wants to vet the process, the job that we've done. And we have ran an electronic underwriting DU approval. We have an approval, electronic underwriting approval. That would be one. And we have verified assets. We have seen their bank statements. They do have the money. We have calculated their income. We have a verified income with their HR or whatnot. So we have done as much work as possible before issuing that letter upfront. So we don't like surpriseless. When we're in contract, that loan must close. So if there's an iota of question, like of doubt we have, we're going to go and vet that. We're going to ask questions. Sometimes there's complicated scenarios that I will email an underwriter and ask, and I will get as high a certainty as possible before I issue that letter. Now, when the listing agent calls me, they're like, David, who are you? What have you done? What kind of job have you done, right? So when I tell them, listen, I've got income verified, I've got assets verified, I ran DU, I have an underwriting approval, I have a very clean underwriting approval. All I need is a contract from you.
Sorry, guys. David must be getting a call. That's okay. So can you say it again?
Yeah, sorry.
That's okay. We lost you on when you said that you got the income verified. Can you go back to it?
Sorry about that. So I guess when my family calls, the focus time does not apply to it. Okay.
Family.
So when the listing agent calls us, and it's the most important call, in my opinion, the listing agent calling and vetting the lender is the most important call of the transaction. I mean, should they accept your offer? I would never misrepresent. If I haven't done the job, I wouldn't tell them that I have. It's a reputation thing, and it's a very tight-knit community in Las Vegas that I have, and we all cherish our reputation. So which is why I tell clients, you need to be, I need to do the work, because from that conversation is going to depend whether we'll close the loan or not. Okay, whether you'll get that house when you start shopping. So, okay, you've made an offer, you like a house, you really want this house, and the listing agent's going to call me, David, what have you done? Should I accept this offer, right? And if my answer is, Mr. Agent, I have verified their income, I have verified their assets, I'm in possession of their statements, I have verified their credit score and their credit report, I have ran a DU approval, and I have a very clean desktop underwriter approval, which is the Fannie Mae or Freddie Mac, whatever. I've done everything I could on my CIA, my credit income assets. My loan is solid. My pre-approval is as solid as it can be. There's nothing that I can do further. All I need is a contract. 90% of the time, I'm going to have a contract in my mailbox in the morning, because that's what they want to hear. This is going to be a very smooth transaction. And I had a I had a call. These calls are very frequent. I had a call on a Saturday evening. I'm with my daughter in the park, and I answer the phone, and we go through the spiel. Monday morning, I have a contract, and literally in 10 days later, we're closing this transaction because it's such a smooth, easy transaction. The work was done. There was no risk. And yeah, he was even surprised.
And this is my next question. So you mentioned something that my next question was going to be about underwritten pre-approved. What is underwritten pre-approved, and how it is better than the regular pre-approval, and how it actually helps the process, and like to which point in transaction the underwritten pre-approval takes you, and why it is like the best possible thing that the buyer and the buyer's agent can bring to the seller.
Okay, so underwritten approval, since I'm not an underwriter, right? Let's understand who the underwriter is. It is the person at the bank that underwrites your loans, basically makes sure that your paperwork, your credit income assets, and everything else, the appraisal, the escrow papers, your insurance, the whole package fits the box of a certain loan, of a certain guideline, whether it's conventional, whether it's VA or FHA. The underwriter's job is to make sure that your paperwork fits the box and it's clean, basically. So underwritten approval would be when we submit paperwork to the underwriter, get a TBD, we call it TBD approval, TBD meaning we don't have an address, so the address is 123 TBD Street. So we have a TBD approval. Now, it's not David's opinion, it's the underwriter's opinion. It is a loan approval that we have that gets submitted along with the offer. Now, do we get underwritten approvals? If the client wants me to, I will submit that. That takes another 4 to 7 days. So if you're ready to wait and not shop for another 4 to 7 days, that's fine. I don't do underwritten approval on every loan because there's no need to. I believe I'm experienced enough where I could tell whether that loan's going to close or not. And if I have questions, then I'll go to the underwriter. Not every loan, especially if it's a very simple vanilla loan, it does not need to, because it's just a time suck, and we know how agents and clients want to get out there and start making offers. So that is not a necessary thing, but it carries a lot of weight because now it's not just the loan officer's opinion of whether that loan will close, but rather the person that actually does approve the loan.
It's the banks. And when you have the underwritten approval, and the day you get into the contract, does it help to speed up the process? Does it help for the buyer to get into the house faster and to get to the close of escrow faster, or does it not affect the timeline of the loan closing?
It could, about 3 days, 3 to 4 days. It's not going to make or break a deal. If you have a tight deal, then yes, we just closed the loan in 8 days because we had everything. You see, if you want me to break it down to the nitty-gritty, then what happens is once we have a contract, we do the initial submission, we get an initial approval. Initial approval has a bunch of conditions. This is something that we explain our buyers, and it's worth mentioning that the initial approval is not the final approval, hence initial approval. It's got conditions. One of the conditions would be appraisal and some documentation from escrow, some documentation from the HOA, the insurance, maybe some documentation from the borrower. This is not as frequent because we usually collect as much documentation from the borrower as possible. So the initial approval it's like the bank, the underwriter says your loan's approved based if you provide all of these to me, right? So that's the initial approval. That's when we're starting to collect all of these documents and we're waiting for the appraisal to come in, and then we submit for the final approval. A perfect loan would have initial approval and a final approval. In some complicated scenarios, you could even go back and forth with the underwriter. There'll be another approval come out, and then another. So it really depends on the level of your complication. Yeah, so I hope that answers your question. When you have an underwritten approval, you technically have your initial approval, you technically have conditions. So that initial approval is out of the way. You can disclose and order appraisal. That may save you 3 or 4 days, may not, really depends.
From the standpoint of the agent who constantly represents buyers, like there's things that we put into the contract and there's things that the listing agent is going to look at in order to present an offer to the seller. So one of the things that actually goes into the purchase agreement is going to be the time frame within which the loan application has to be submitted. And in my practice, what we practice in Nevada Realty Experts office is this: we are not taking you out house shopping unless you're approved with the lender. So if you get the approval, like if you come to us with that approval, that's great. If you don't have the approval, we're going to connect you with the lender. We're going to assist you to find the best fit lender that you can have and get that letter of approval, get the understanding on the price range that you are going to be shopping in. You're going to understand what is your expected monthly payment. So we're going to acquire this letter from the lender before we go house shopping. Mm-hmm. And that's why when we submit the contract with our buyers into the part where it says loan application, like I personally place that loan application is already completed. And that is a big deal because I do not want to bring the contract to my personal seller. Like if the contract that is submitted for my seller says that, oh, we're submitting an offer on your contract, but we're going to take 5 days to talk to the lender, like my answer to that kind of offer and what I tell the sellers that we don't even know if this person can or cannot afford to buy the house, because if that loan application is not completed, if they're going to take the next week, then we'll welcome these people to come to us in a week when they've done the proper work and actually submit an offer. And guess what? 30% of those people, they're not going to come back to us because they're going to learn that they're not even qualified. Or if they're qualified for the way lower amount that they wanted or that they were trying to submit. They're going to learn that with the current interest rate, the payment that they're going to be making for this house does not fit their budget. So there will be a lot of factors. So if you guys are shopping for the house and when you and your agent are filling in that place for the loan application, make sure that for the strong offer, you say that this application has already been completed. Now, the next field that we're going to fill in is going to be the amount of days that the buyer is going to take in order to get the appraisal and get the appraised value. Now, David, tell me, what does the appraisal do for the loan, and why, if I have a purchase price of $100,000 and FHA loan, and my appraisal comes at $80,000, what happens?
Well, the appraisal, first of all, is for the bank, first of all. The bank is loaning you money. So they need to make sure that the property that they're loaning this money against is worth the price that you're paying for. So the appraisal is not only for you, but first of all, above all, it's for the bank, right? Now, right. So your loan amount is the lower off your purchase price or your appraisal. Not the loan amount, excuse me, the 100% of the loan amount that the loan will be based on. Does that make sense? So let's say you're paying $100,000, the appraisal comes in at 80, even though your contract says 100,000, it's going to be the lower off your contract purchase price, the offer price that you're making, or the appraised value. Now the bank's going to take the 80,000 as the basis of your purchase. You're going to make a down payment. We started talking about.
Let's say it's conventional. Let's say it's conventional with 10% down.
Okay.
for the ease of the math.
Right. So they want you to put 10% down off the 80,000. So your loan's going to be $72,000 because the bank doesn't care what you're paying. You could be overpaying by $300,000. As far as the bank's concerned, this is an $80,000 property. And if you're structuring this loan as a 10% down program, then it's going to be 80,000 minus 10%, 8,000. Your loan will be a 90% loan to value, 72,000. Now, there's another, obviously, aspect to this. You're in contract with the seller to pay them $100,000. This is where your agent kicks in, their agent kicks in, and they help you sort of discover where that middle ground is, whether you're going to pay the whole difference of $20,000 from your pocket, or you're going to meet somewhere in the middle, maybe at 90. So they drop 10, you go up 10. So there's no blueprint for this.
Yeah, there are multiple variations, but what is important, guys, why we have the appraisals? Because when we submit an offer that is subject to financing, it means that we come to the seller straightforward. We're honest with the seller, and we're telling the seller, dear seller, I don't have the cash to pay for this house. I will be asking the bank to borrow, to lend me money for purchase of this property. And I already done my initial paperwork with the bank, so the bank knows that I'm a qualified borrower. But now, not only, the fact that the buyer qualifies, that only one part of the equation. The second part of the equation, the house, the property itself has to qualify for the loan, because the bank is not going to lend you the money on something that doesn't qualify. And the property has to qualify based on the condition and based on the price. So the reason why the appraisal is in there, and the appraisal is the way of the bank of protecting itself, and that's another reason why we're having better loans, and we're having better mortgage situation right now, is because the bank is not going to, if the bank orders the appraisal and appraisal comes at, if we're talking about our example, if you promise, if the seller wants $100,000 for the property, but the appraisal comes and the bank says, no, the house is only worth $80,000, and this is the most that this is the biggest amount that the loan is going to be based off. So the bank is only going to give you whatever the percentage, whatever the program you're using, from the appraisal value, not from the purchase price. And those two, it's perfect when those two match, but if they don't match, there is a gap, then we have to deal with the gap, and the gap needs to be covered. And the bank is not the one to cover that gap. The bank is not going to allow you, the bank is not going to listen that your purchase price on the contract is $100,000. They're going to go off the appraisal. Correct, David?
That's absolutely correct. Can I take this up a notch? I mean, your example is obviously for the first-time home buyer, someone that's not very tempted in these purchases, and we're happy to work with them. But let's say you're putting 10%, 20%, whatever down, and your appraisal comes in low, and now you don't have the difference of making up the difference between the appraised value and what you want to pay for this. What do you do? What do you do when you're, let's say you're doing 20% down and you don't have the difference to put out of pocket? That's all you got, 20%. Well, guess what? Here's what you can do. You can put less down. You could do 5% down. You could be 10% down, right? You could allocate that difference towards the appraisal gap, the difference. Yes, now you have a bigger LTV, not necessarily loan amount, but LTV. And what you can do is you can buy out the mortgage insurance, because if it goes above 80%, it gets a bit complicated. It's mortgages 2.0, but when someone puts more than 10%, that's what it usually works, 15%, 20%. Now we are more confident, even if the appraisal comes in low, we can increase loan amount instead of 80%, because most people prefer 80% so they don't have PMI. Well, you could go 85%, 90%, take that money, put the appraisal, pay the appraisal difference, and now a PMI kicks in. PMI is usually several $1,000s, and you could pay out of pocket. All of a sudden, you just bought a house, which before it's not a very intuitive thing to do, but it's a very shrewd thing to do, in my opinion. And some experienced loan officers.
David, the truth is, when you've done it for a while, you've seen, like, they're pretty much, I can probably name you 15 different scenarios, how that could be, like, played out, the scenario when we have the appraisal below the purchase price, like, and there are things that we can do, but it will all depend on, like, if the house is worth it, if it's worth it for you, if it's the house, or we need to move on. There are certain things, like, and this is very important, guys, for you to know, that no two contracts are the same. It is not cut and dry. And like every house purchase, every contract plus the loan, it's like a puzzle. And you want to have two professionals working with you, a professional real estate agent and a professional loan officer, so that we could put the pieces of this puzzle together into the final picture that will have the best terms for you as the buyer and will deliver you the best result. Because honestly, guys, the same house could be purchased in, like, multiple different scenarios where you will have different amounts of money to bring into the close of escrow, when your payment will be different. And once again, there's so many scenarios that are that could be implemented, that we sit down, like, every time before we submit an offer, I call the lender and I talk to them. I talk out the terms, and we talk out if it's going to work or what are the most favorable terms for our buyers. And then after we go through the negotiations, a lot of times during the time when we go through the negotiations with the other side, we still call the lender. Very, very often the lender is on the third line with us, because we're moving those pieces of puzzle, trying to figure out if it is possible to work it between the buyer and the seller, so the seller gets their net line, so the buyer gets the payment that they need, so the buyer has enough funds to actually close the transaction, and that the time frame works for every single party. And so there's things that they might sound complicated, but that's why you need two professionals, like, behind your back, and this is your experienced real estate agent and your experienced loan officer. And talking about the timeline, there's another timeline that goes into the contract, which is called loan contingency. So when we submit an offer and we tell the Mr. Seller, I don't have the cash to pay for this house, but I did talk to the bank because my loan application is ready, has already been completed. I am going to order the appraisal because I still depend on the money that the bank should issue for me. So, and the bank needs to confirm the value of this house. So please give me an X amount of time to order the appraisal and to get that appraisal report back, and to confirm that what we offered you for the house is actually a good amount, and the bank agrees to it. And then there's a third option, like the third paragraph in this purchase agreement, that states loan contingency. So how much time we have for the loan contingency. And this is exactly what David was talking about. The loan contingency starts from the day that we have an fully executed contract, till whatever the period is in calendar days is indicated in your contract for the bank and for your loan officer to shuffle all the paperwork, whatever needs to be done, back and forth until we get that final approval. So the final loan approval that David was talking about, it means that meeting all of the underwriter's condition and getting getting pretty much the fully underwritten approval. This is what needs to happen within that loan contingency. And David, can you tell us, like, what are the parts that go, like, what are the processes that need to happen, and why it is not smart to have that loan contingency to be like 5 days or 7 days?
So loan contingency is the last, in my opinion, line of hope protecting the buyer's earnest money deposit. So loan contingency, we don't always, and that would be a lie, I think, for any loan officers that would say that they have a final approval by the loan contingency expiration, but we need to have a very, very, very high level of confidence that that loan will close if we're going to let that loan contingency expire. And I'm comfortable letting it expire as long as I know that I have a loan on my hands. Does that make sense? If I don't feel confident, then I'm going to ask you, my partner, or the other agents to extend the loan contingency because we're still working and it's still kind of up in the air. So loan contingency is there to protect the buyer's deposit, and will basically, if we cancel within the loan contingency periods, the buyer will, because the loan did not get approved. It's called loan contingency because the loan did not get approved. The buyer will get their EMD back.
And thank you for reminding. Yes, guys. So the appraisal, like if we have an issue with the appraisal, if the appraisal comes in and it doesn't confirm the value, and we are unable to arrive to any kind of a common ground with the seller, it doesn't mean that the buyer's earnest money deposit is going to go to the seller. So if we cancel the contract due to unsatisfactory appraisal, the buyer gets the earnest money back. Now, if we cancel the contract within the loan contingency period because there is an issue with the bank, or straightforward, guys, I've had it happen before where the buyer lost the job. The buyer lost the job in the middle of the loan process, and there was nothing that we could have done. Like if you lost your income, then your loan application pretty much stops, because we couldn't go any further. So if that happens, once again, your contract can be canceled and should be canceled, and your earnest money is going to go back. Now, one thing that you don't want to do, you don't want to wait with your paperwork, like when the loan officer asks you, I need you to provide me with this. I need you to provide me with this phone number. I need you to provide me with this bank statement. So if you need to submit your bank statement, like today is March 1st, probably before March 5th, everybody's going to get their bank statement. So go ahead, do not wait for your loan officer to call you and to tell you that you need to submit it. Go ahead and submit it. Get all the paperwork as soon as possible so you meet that loan contingency requirement, and that your money is protected, and we actually have all the tools in our hands to protect you, to protect your deposits, and to make sure that the property that you like, the house that you like, you can get it financed. And David, before I let you go, there's another question that I probably got at least 30 times within this week. And my question to you, can you please elaborate on the fact when we actually lock the rate, and why when we come and talk about the rates and about getting a pre-approval, those rates can change, and what are the factors that can affect the rate, and how can the buyers get their rate lower, and what is the free rate and what is the buy down?
Okay, so that's more like 5 questions. Okay,
you know me.
Let's talk about it. Okay, the interest rate. what is an interest rate? That's when you apply for a loan based on certain criteria. It's going to be your occupancy. The occupancy, meaning, are you going to live in it? Is this your vacation home? Is this your investment home? Is the biggest factor that determines interest rate and down payment and all. So occupancy, your credit score is a big, big factor. We want your score to be above 700, 740 being tier 1, the best credit score on the planet for conforming and FHA loans. Anything north of 740 does not help you to get a better rate. But so credit score, occupancy are probably the biggest, property type would be, whether it's a condo or a single family home, sometimes makes a difference in your rate. So they call that LLPA, loan level price adjustments, LLPA. You could Google Fannie Mae's LLPAs. There's a spreadsheet, it's no secret, or a PDF document online, and it does give you the loan level price adjustments. And I do talk about it. I do show it to clients. All right, so if you go from 5% to 20%, there's a slight adjustment. If your score drops from 720 to 660, there's an adjustment. So loan level price adjustments are a thing, and they do. Obviously, the lower your interest rate, the less dollars out of your pocket. I think this is something that I quite frequently stress, and I want to talk about this. Most people focus on the rate. You need to focus on the dollars out of your pocket, because sometimes not always the lowest rate ends up being the lowest payment. So, and that's something, it's up to us as coaches, as teachers, as consultants to explain to people that let's find that lowest payment. What you're looking for is the lowest payment is what you're looking for. So that's that. That's the loan level price adjustments is what affect the interest rate going up and down. You want to maintain as low of a debt as possible. Do not apply for anything. Make sure your score is as high as possible so you can qualify for that rate, that as good a rate as possible. Now, when do you lock? When you go into contract.
What is locking? Let's talk about what is locking the rate. Like, what is it like, and why it is important?
Yeah, so when someone calls and asks what the rate is, or when I'm meeting with a client and I'm quoting what the rate is, and I'm opening the bank's quoting machine and I'm plugging numbers and I'm telling them, hey, the rate is this. It doesn't mean you have this rate. It just means that I showed you today's rate that this bank has as of that hour. Rates could change.
Can I add one more thing? So if I came to you in December, like if I came to you on January 5th and we had this conversation, and now it's March 1st and I'm bringing you the contract, and I'm like, David, where is why are you giving me a different number? Why is this number different? Of course, if it's lower, I'm not going to complain, but what if the number is higher? Why is it higher?
And it's one of the items on my cheat sheet that I talk to clients about, so I don't forget. We do stress that rates vary. They go up and down several times a day, many times a week, and obviously they're going to go up and down. They're going to zigzag many, many times over, from especially if it takes the buyer over a month to shop. Now, again, your rate is not locked. That's something that's getting stressed often. Your rate is not locked. There are programs that are called lock and shop. Lock your rate and shop. This is good in some cases, not all the time, but because in case if the rate is dropping, then lock and shop is not necessarily a good thing. Now, you could also lock and shop for a longer period, because if it takes you a week or two to shop for a home, you don't know when you'll really go into contract, and this lock's about to expire. So we traditionally would prefer, if it was my mortgage, I would lock as soon as I'm in a contract. I would not lock prior, and a lot of the banks don't even have the lock and shop option, which means it reduces the pool of banks that I can work with. So that's about the lock and shop, because some people are like, oh, I thought my rate was locked before I started shopping. Well, not really, but it can be if you want to. It's a risk. It's not always good, because
it will cost you money up front. Correct.
So I have to lock for a longer period. If my traditional lock would be 3 to 4 weeks right now, the lock and shop would probably be a 45-day lock, and that's going to be a longer, more expensive locked in a 3-week lock. So your rate's going to be higher. Do you want that? Now, yes, you have a lock. If rates go up, you have this. Now, you need to basically go into contract and close on this mortgage within 45 days. If you don't, and if you want to maintain this lock, there's going to be lock extension cost. So locking technically is fixing your rate. It's a process. There is a lock screen. There's a lock protocol that the bank has to go through, and there's a lock document. Once the client goes into contract, we're going to either have them come in, we're going to call them, and we're going to tell them, these are the rates. Do you want to lock? We're going to give you the option. It's your loan. Whether you want to wait, whether you want to lock now, it's completely up to you, really. And some people are, David, I think rates are going to drop. I want to wait. Some people are, you know what, let's not risk it. Lock it. Let's be done with it. And we lock.
And this is very important, guys. I want everybody to pay attention to it. The rate that you've seen while getting your pre-approval letter or while meeting with your lender is like in 99.9%, it is not locked. So by the time we're in the contract, you need to have the rate conversation with your lender once again. And there is a certain procedure. If you're in the contract right now and you have not gone through anything that is called rate lock, it means that you don't know what your rate is going to be right now. And it's not necessarily going to be the number that you've seen when you got pre-approved. It's not going to be the number that your cousin got when they closed last week. It's not going to be the number that you see on, like, when you Google it. It's not going to be the number. There are a lot of moving parts into it. And until you actually lock and you get a document from your lender that this is where your rate is locked, then you don't have it locked. You're still in the limbo, and you're pretty much playing with fire if you're not locking your rate on time. Correct?
I agree. Yes, I agree. So whether you want it or not, we're going to have that lock conversation.
Exactly. And
it's our job to have a lock conversation with you.
This is a procedure, and you get your rate confirmed. Now, there's such a thing as the rate buy down. So can you tell me what is the free rate and what is the rate buy down?
Rate buy down essentially means, okay, let's understand what par rate is. Par means based on your, as I mentioned, credit score, down payment, occupancy, and other factors, we find out what your rate is that you pay nothing for. That's your par rate. Or you could call it free rate. That's the rate that you get that you qualify for. Okay. Some people with higher credit scores will get a better rate. Some people with lower credit scores will get a lower rate. That's your par. Once we've determined the par, you have the opportunity to pay extra money out of your pocket and buy it down. Now, the lower you buy it down, the more expensive it's going to cost, obviously, and you're going to save more money. The lower the interest rate, the more savings you will have. You can ask us to help you to sort of calculate the break-even period. Okay, so I spend $5,000, excuse me, to buy it down a certain percentage, a quarter, half a point, and I'm saving $250 a month. Should I do this? So we'll help you determine, take the cost divided by your savings, understand what your break-even period is. And it's going to be different on every loan, on every scenario, and then you make the educated decision whether you want to spend extra money to get that low rate or not.
So one question that I dealt with a lot this past week is like, who determines the rate? Like, if I go to a different lender, am I going to get a different rate? And could you tell us, like, where does the rate come from? Like, does it come from the lender's hand? Does it, does it mean that if I go and do the same loan with a different lender, it's going to have, I'm going to have a different rate, or I'm going to have a lower rate? Like, let's say if you're quoting me, like if you're saying, Alexandra, you're getting an FHA loan today with the 6.75, and I'm like, no, I think I should go better. Like, I think that the lender across the road can get me 5.5. Like, will the lender get me 5.5 without me paying for it? Or it doesn't matter. Like, changing the lender will not change the...
Those bigger leaps, as you mentioned, 5.5 to 6.75, that's not going to happen. You better read the fine print. You better read the fine print there.
It's not going to happen without me paying out of my pocket, correct? Without somebody paying for it.
There's somewhere on second page somewhere buried a cost, a buy down. Technically a buy down is just involuntary. You didn't choose it. It's just, it was disclosed to you as a buy down just to accomplish that low rate. But in some rare cases, some banks want to compete. Banks compete with other banks as well. So sometimes they publish a low rate in a certain category. In 720 plus jumbo loans, 720 plus FICO jumbo loans, a bank wants to be the leader in the industry. So they will drop their rates versus others, and they'll eat the difference. And we as brokers, we shop a bunch of banks and we see which one the lower is for that particular client, and we send that file to them. We don't have an in-house rate, so we're not bound to one rate. We work with many banks, we shop and see which one the lowest is. Most of the time, most rates are going to be very much identical, very close to one bank to another, but in some cases, when banks get aggressive, they want to dominate a certain niche. That's when we will send files to them, because we're going to get the better rate versus others. And our goal, I think it's worthy of mentioning that our compensation is not directly tied to the interest rate or the type of loan. So we don't technically have an incentive of choosing. Some people may think we have an incentive of choosing this rate, and we don't choose. We consult you, and we really don't care what you choose. Technically, there's for the lack of a better term, we don't care what kind of loan you choose.
You don't
but we will
benefit. You don't benefit from the rate
Yes.
that the person is going to choose.
So we'll
Neither you're going to offer the lower rate than the par rate. Like, if the bank is offering the par rate, unless somebody is paying for that buy down, you are not you're not within the freedom of offering the lower rate, and you're not going to do that.
Misrepresenting, in my opinion. So I'm just going to give you the par rate. You want to buy it down, you're welcome to buy it down. It's coming out of your pocket. And just to misrepresent, again, I'm going to mention this again, when I'm doing a face-to-face consultation at the office, I'll always open Quicken Loans, one of the bigger names, and they have very beautiful rates on their website, 30-year fixed mortgage, and there's always 1 or 2% buy down somewhere baked in the fine print. So, and I do show this, and when we open up our rates and we shop in front of the client throughout many banks, and they'll see that our rates we're quite often way more competitive than other banks.
And once again, I think this is extremely important to explain to people, guys. When you go online and you start Googling the rates, like, if you really want the truthful information, go ahead and send the link to your lender, to the lender that you're working with, because a lot of times we have this situation where you go online and you're like, oh, I seen this rate, like you screenshot it and you send it to the lender, and you're asking the lender why my rate is not that low. And something that David and I discussed previously, like, a lot of lenders, they publish the rate with the 1 or 2 points buy downs that are going into the fine print. Or let's say Fannie Mae does not do the fine print, they just change their terms. They're publishing the rates with the 1 point buy down, which means that you're buying down by 1%. You're buying down 1%, and this is the rate that they're publishing. So inevitably, when you go and look at this rate online on Fannie Mae, like, put 1, the whole percent, add the whole percent to it, and this is what the going rate is going to be. So don't get, don't get distracted, don't get misinformed. If you're looking at some rate, go ahead and send the link from the source to your lender, so your lender is going to show you why that rate is where it is, because there is inevitably a fine print where it says these are 1.5, 2 points of buy down. So can you do it with any lender? Absolutely. You can do the buy down. You can pay for your own buy down. You can ask the seller to pay for the buy down. You can lower your rate, not to the 0 point, but you can lower your rate, significantly lower your rate. But remember, somebody has to pay for it, and it's either going to be you or it's going to be the seller. One of two parties has to pay for it. It does not come just because, it's not such a thing as, oh, the lender just doesn't want to give you the lower rate. The lenders always want to give you the lower rate, because the lower the rates are, the more loans David is going to process each month. But it is important for you guys to know how it works, and it is important for you guys to know, what factors influence the rates. Now, we're not expecting you to be real estate agents or loan officers, and this is not the video for you guys to learn the process and go get your real estate or loan officer license. This is the video for you to understand how the things work and how they influence one another, so that when you have this conversation with the lender, when you are getting frustrated or when you're getting lost in the amount of information that comes to you through from all over the place, and you obviously have, every time you house shop or mortgage shop, you have the internet, you have Instagram, you have all kinds of sources, and then there is a cousin, and then there is your hairdresser who is giving you the loan and the mortgage advice. There's always going to be 10,000 different opinions, and everybody knows what they're talking about, but please, please, please make sure that you get your information explained to you and broken down to you by the person who actually does it for a living. We all love our hairdressers, especially David. He loves his. But, if you need a haircut, go to your hairdresser. If you need a loan, go to David. Do not get the information from, from the person who doesn't do it for a living, from the person who cannot help you with 10,000 different scenarios, and who cannot sit you down for 30 minutes and actually draw it on a piece of paper and explain to you, if we put more money here, this is what is going to happen. If you want your payment to be this is what's going to happen. There are a lot of moving parts. There are 10,000 different scenarios that we can apply to every single deal. And what your pre-approval letter is and what you get into the contract, those two things could be very much different. And the interest that you see when you just get pre-approved and the interest that you lock, they could be very much different. The payment that you can get for putting 5% down with one interest could be way lower than the payment that you're getting with the 10% down for the same amount but with the higher interest. So it's a game of numbers. And David knows how to play it. He knows how to present it to you, and he knows how to explain it to you. So don't get frustrated. There's still plenty of opportunity in this market, even though we're the toughest market in regards to the inventory right now. But we're still shopping with a lot of clients, and we're still here, guys, to help you to lower the rate, to get the best terms, and to get the best homes into the contracts and to move you into the best homes possible. David is like, I have to go.
I have to jump into my coaching call.
So thank you so much, David. Thank you for your time. Thank you for the wealth of information that you are always sharing with us. Once again, guys, David's information is going to be in the description to this video any questions that you have. If it is a general question, we'll welcome it into the comments. If it is a personal question, please call or DM us, because we're not going to discuss your private information publicly on our social media, on YouTube. Like, that calls for a personal call and consultation.
Thanks, yeah. Thank you, Alexandra.
Thank you, David. Have a great day.
All right. Bye-bye.
Bye.